The Consumer Price Index was announced on Thursday, and it was the highest level of inflation that we've seen in 40 years.
Wow.
Yeah, so that's pretty big news.
I did see that.
Okay, you did see it. It was the big news in financial markets. It's affecting stocks, it's affecting bonds, it's affecting mortgage rates, it's affecting a lot of things. And this was inevitable. Listeners to this program knew it was coming. I've been telling you for over a year, longer than that, maybe 2 or 3 years, that all this money creation that the Federal Reserve has done between their quantitative easing and printing $120 billion a month and buying bonds. Oh, by the way, that's what we know. There's so much we don't know about the Federal Reserve, and we'll talk about them pretty much a lot in the first hour here. But they created this. This was not something that was a big surprise. You don't just increase the money supply 100% and not expect to see inflation. And that's exactly what they did. So the inflation was announced on Thursday. The CPI came in stronger or higher than people expected, with prices rising 7.5% from a year ago. Now, if you believe that, I have a bridge to sell you. I mean, we have coffee up 92%. We got gasoline up 60%. We got food up 15 to 20%. We got used cars up 41%, which is amazing to me. The appreciation in used cars is just like the best investment you could have made in the last couple of years is buying up everybody's used cars, up 40%. Can you imagine that? Natural gas up 30%, electric bills up. And the Fed's telling us that inflation is only up 7.5% from a year ago. All right, you can believe that if you want, but it's at least double that. And economists out there, the one guy I follow, which is John Williams, very seasoned economist, he keeps stats on the economy like they used to back in the 80s before they started tinkering with them to make them look better. And he says inflation right now is 14.8%, the way he calculates it, and the way it was calculated back in 1982. Well, in 1982, inflation was 14.8%. Actually, it was 1980. That's when inflation peaked. So if we're at 14.8 real inflation, right, and we have interest rates still at zero, how does this inflation get that low? Now, of course, the Federal Reserve is out there indicating that they're going to start raising interest rates very soon. Some people everybody expects the March meeting when the Federal Reserve gets together that they were going to start increasing interest rates. Initially, everybody thought it'd be 1/4 point on the Fed funds rate, and now the talk is 1/2 point. There's even talk in the markets that they may raise interest rates before the meeting, which would be quite shocking, I think, to the financial markets. But the bottom line is the Federal Reserve is behind the curve, meaning that they've let inflation get too out of control now, and they do not have the tools to battle it. Now, if we go back in time, back to the 40 years ago when we had inflation, Paul Volcker then was the Federal Reserve chief. And he was only a couple of months into his term when inflation hit 14.8%. And he started raising interest rates. And not only did he start raising interest rates, he raised interest rates aggressively. But the point to note here is that where did he start raising interest rates from? He started raising interest rates from 11.2% in 1979 all the way up to 20% by June of 1981. So we were already over 11% in interest rates. Where are we today? We're at 0 interest rates. That's how far behind the curve the Federal Reserve is. And the problem with the Federal Reserve's task ahead of them now is they can't do what Paul Volcker did. They can't raise interest rates high enough to make a difference in inflation. What are they going to do? Raise it? The big talk on Wall Street is they're going to raise it 4 times, maybe 5 times, maybe 6 times, to 1 to 1.25%, maybe 1.5%. All that's going to do is destroy the economy, destroy the financial markets, and inflation will still be raging. And the Fed knows it. So Wall Street is all upset, thinking that the Fed is going to be very, very aggressive in interest rates, and realize the reason why the stock market rose to levels where it did, it wasn't due to economic growth, it wasn't due to the growth of corporate earnings. In the face of a pandemic, in the face of 60 million people losing their jobs, supply chains being messed up, the stock market continued to go up in 2020 and 2021. And now the stock market's starting to get religion. It's starting to realize that, hey, this artificial stimulus that we've had in the stock market is not here forever. And if the reason why the stock market ran to where it did was low interest rates or zero interest rates and quantitative easing and money printing and easy money. Well, if the opposite's going to be true, what's going to happen to stock prices? Well, the opposite's going to happen. Prices are going to go into a bear market, and we're starting to see that now. This week, the market's very, very volatile and have been since the beginning of the year. The Dow Jones Thursday was down over 500 points after that CPI announcement. Friday, the market was down another 526 points. And year to date, the Dow Jones Industrial Average is down 4.5%. And we're in the middle of February. But that's the best market of all the stock markets. Let's look at the S&P 500. The S&P 500 was down 1.8% for the week, down 7.3% for the year so far. But that's good when we look at the NASDAQ. The NASDAQ, which has all those big technology companies in the index, down over 2% for the week, down 2.8% on Friday alone, and down almost 12% year to date. So we're seeing reactions in the market to these rampant inflation numbers that are coming out, even though they're understated. People in the market know they're understated. Americans know they're understated just by their life living it and going to grocery stores and filling up their cars and paying their electric bill. We all know it. But we better get ready to live with it because, again, the Fed has no tools. They're going to talk a good game, and that game, if they raise interest rates, say they raise interest rates to 2%, I don't think the markets will allow them to do it. But what's going to happen? You're going to see the housing market collapse. You're going to see the stock market collapse. You're going to see the economy collapse. Because the Fed's saying that, part of its inflation is this robust economic growth that we have. And that's nonsense. We do not have robust economic growth. That's not causing inflation. What was causing inflation was the Federal Reserve itself and its monetary policy. And the Fed knows that. And if the Fed foolishly raises rates, it's going to cause a recession or worse. Some economists, this guy John Williams, says if they start raising interest rates, we're going to have an inflationary depression or a hyperinflationary depression. Or at best, stagflation. What's stagflation? Stagflation is you have inflation, but you either have a recessionary or stagnant economy. So this is really serious stuff that's going on right now. And as I said, our real inflation rate, calculated the way it was calculated in 1980, puts us exactly where, to the 0.1% at 14.8%, and we have zero interest rates, and the Fed is talking about maybe raising it a 0.5 point at the next meeting or sometime soon. I mean, this is a joke. And financial markets know it, and that's why we're seeing such volatility out there. Energy prices, a big driver of inflation. Why is energy so important? Because it filters through to everything. You got to drive to work, fill up your car. You have to ship something somewhere. Well, there's gasoline in that truck. Or there's jet fuel in that plane. Or there's fuel in that tanker ship that's coming across the sea from Asia. How about manufacturing? It takes energy to manufacture anything. So if the cost of manufacturing goes up, the cost of the final good goes up. So energy has been a big driver of inflation because it does filter down to everything. Every aspect of our lives are touched by energy prices. Oil closed at a multi-year high at $93.90 a barrel on Friday, and looks like it's easily going over 100. Where the top is on oil, who knows? We may see a big spike due to geopolitical issues. We'll talk about Russia and Ukraine later on in the program. Big problem. So energy prices is the culprit. Now, Joe Biden came out this week, and he's been asked about this. I mean, this is a big thing because inflation is something you can't hide. You could lie about the CPI, you could do that stuff, but you can't hide it from the people. People go out and buy things. They see with their own eyes. They see what the cost for a full cart of groceries cost. It's amazing. So Biden was asked about the inflation after that CPI came out, and this is the coherent explanation he has.
Is that we're in a situation now where you should have peace of mind. We're working to bring down prices where they're not totally what families, in fact, have to pay now.
Okay, so he's working to bring down prices. How's he doing that? He must have some incredible powers to do that. Now, Lester Holt, not an enemy of the administration or the Democratic Party by any stretch, interviewed Biden for, I believe it's going to be on before the Super Bowl. What are you laughing for, Jim? You don't want a little dose of Biden before the Super Bowl?
It's like the last thing I want to watch before the game.
Well, traditionally, the President of the United States is interviewed before the Super Bowl because he's got the vast audience out there of the country, and it's a good time to talk to them. Now, usually, the President of the United States is live being interviewed before the show. But there's no way this administration is going to take the chance of putting Biden on live and seeing what he says or stammers or whatever. So here's part of the interview. Now, Lester Holt asked him about inflation. And whenever Biden gets asked a question that he doesn't like, he gets really kind of angry. Listen to his response. Now, this is a friendly reporter.
There was today's sour headline on the economy. Inflation skyrocketing to 7.5%, a 40-year high. Prices still spiking on everything from used cars to gas to food. Inflation now costing the average American an extra $275 a month compared to last year. I think it was back in July you said inflation was going to be temporary. I think a lot of Americans are wondering what your definition of temporary is.
Well, you're being a wise guy with me a little bit. I understand that's your job. But look, at the time, what happened was let's look at the reason for the inflation. The reason for the inflation is the supply chains were cut off, meaning that the products, for example, automobiles, the lack of computer chips to be able to build those automobiles so they could function, they need those computer chips. They were not available. So what happens? The number of cars were reduced, the new cars were reduced. It made up at one-third the cost of inflation because the price of automobiles were up. So what I did when I went out and made sure we started to make those domestically. We got Intel to come in and provide $20 billion to build a new facility.
It takes like 3 years to build a new chip facility, so we're not going to see any relief anytime soon. But why is Lester Holt being a wise guy by asking him about inflation, which is like on everybody's mind?
It's like the easiest question ever. He's a wise guy.
Yeah, he's a wise guy. I mean, they make such a big mistake this minute. Just answer the question. Say, look, yes, inflation has gotten a little out of control. We didn't see it coming, but we're going to do everything we can. We're working with the Federal Reserve, and we're going to do everything we can to turn this around. All right, but just call him a wise guy for asking the question. You're not allowed to ask the President of the United States these kind of questions. But he has no idea, about inflation. And then he says here, he wants to get down the gas prices and energy prices. Well, he's the one who created this problem in the first place. The first thing he did on day one was shut down our pipelines and then shut down our oil leases. We were energy independent. Now we're dependent on overseas in just a short amount of time. And he's saying we have to get gasoline prices down. You're the one who got it up. It's just unbelievable. Everything they've done since they've come in has been the opposite of what you should do. What did he say? Here's a quote. Speaking in Virginia, Biden acknowledged the price hike news. Quote, I know food prices are up. We're working to bring them down. I'm going to work like the devil to bring gas prices down. Well, you work like the devil to bring them up by shutting down our production in your new Green Deal thing. It's just unbelievable. You cause the problem, and then you say you're going to work like the devil to fix it. Well, how about just turning on the pipelines again, giving out oil leases, and let's get our production up. It's not too complicated to figure it out. But again, we need a Paul Volcker, and Paul Volcker could not do what he did in 1980. We have so much debt in this country, in every which way. I mean, government debt, we have family debt, we have corporate debt, we have debt across the entire world that is very sensitive to interest rate changes. So my guess is that the Fed's going to raise once or twice as soon as the markets start getting crazy and the economy starts reporting negative numbers. He's going to pause and say, we can't do this right now because employment's going down and we'll have to worry about inflation and it'll take care of itself. Because there's no way he's going to have the ability to raise interest rates without all hell breaking loose. Just the talk of the first interest rate increase in the country has the stock markets down almost 10%. Bond prices, we've seen yields in the bond market skyrocketing. The 10-year yield that on October 21st was 1.25%, went over 2% on Thursday, peaking at 2.05. It closed on Friday at 1.94, and the only reason it went back below 2 was the rumors going around the market that Russia is ready to invade Ukraine, and there was a flight to safety as people were selling stocks and buying bonds. But that's only a brief stop below 2. So that's a rapid rise in interest rates. And the 10-year yield is what affects mortgage rates. So I was pretty stunned when I looked at the average 30-year mortgage rate this week. I had to look at it twice because I hadn't looked at it in a couple of weeks. And I was blown away. The average for a 30-year fixed-rate mortgage right now in the United States is 4.4%. It wasn't long ago we were talking about 2.5% for mortgage rates. If you want to get a 15-year, it's 3.45. So what does that mean when you see mortgage rates go up? It means that buyers could afford less house. And we've had a big run-up in real estate prices. Why was that? Well, part of it, and a good part of that, was low mortgage rates. Because when people look at buying a house, or anything for that matter, Americans think about what's the payment going to be? And does it fit into my budget? So as interest rates go up, the payment goes up. That means you could afford less house. So if you look at a $300,000 fixed rate 30-year loan when it was 3.5%, which was only a few weeks ago, the payment is $1,350. At 4.4%, that's $1,504. That's a big difference. That's a huge difference. So if the maximum amount you could pay is $1,350, and now interest rates are higher, you could only afford to borrow $265,000 and have that same payment. So you're talking about $35,000 less. That means that's $35,000 less house you could buy. And if you go back to where interest rates were just a year ago at 2.5%, then you can only buy a house you can only borrow $233,000. That's $67,000 less home. So housing prices are very, very tied to interest rates. Fed hasn't even raised interest rates yet. We're still at 0. But the market's anticipating it. That's why we're seeing yields go up in the bond market. And in my opinion, the housing mania that we've seen is ending. If you were thinking about selling real estate, you better hurry up. That window is closing if it hasn't closed already. We're still seeing wild speculation out there. Still seeing it. But that's going to dry up as interest rates go higher. And if the 30-year loan goes over 5%, which is a little over 0.5% more than it is now, this housing market is in trouble. Now, a lot of concern out there about the yield curve. Most people don't know what the yield curve is. Well, the yield curve is the interest rates that you pay or you receive for different maturity bonds. And the theory is the yield curve should go up as you go towards the right, meaning that the longer it takes for a bond to mature, the higher interest you should be paid. And that's typically the yield curve. The 1 year pays less than 1%, the 30-year pays 2.5%. The 10-year pays 1.5%. So you can see as you go up the yield curve goes up and the interest rate goes up. A big concern of market players and economists is when the yield curve inverts. You're going to hear a lot about that now, where short-term interest rates go up while interest rates on the long come down. So now you get a flattening yield curve, and ultimately if the short end goes higher than the 10-year or the 30-year, that's called an inversion. Every recession we've had has had an inversion. Or I should say every inversion we've had has been followed by a recession. So let's look at a U.S. Treasury bond that matures in 2 years. And let's look at a Treasury bond that matures in 10 years. Back in January of 2021, a little over a year ago, the difference in yield was the 10-year yielded 1.6% more than the 2-year did. Today, it only yields 0.4% less than the 10-year, the 2-year. So we're very, very close to inversion, and many economists believe that that inversion is going to happen shortly and is a significant indicator of recession. So this is the big story, people. This is the story that you're going to hear about, you're going to feel in your own life, and the question is, can the Federal Reserve do what it takes to battle this inflation? And in my opinion, the answer is no. They'll talk a good game, but no way are they going to raise interest rates anywhere near the level that it would take to battle inflation, and even a small increase in interest rates will throw the country into a recession. And it's not like other recessions. This is going to be an inflationary recession. And why is that so important? Because as you have recession, people lose their jobs. And as people lose their jobs, in the face of rising cost of living, well, I wouldn't want to be in that position. Now, one thing about the inflation numbers is that the Bureau of Labor Statistics says housing prices rose 4.4% from a year ago. Or housing cost, I should say. They don't use the value of the home as an inflation indicator, which they should, but they know they don't want to use it because it'll make the numbers look too bad. So what they look at is equivalent rent. Now, I told you last week that it was announced that rents have gone up over 13% year over year. But the Fed comes out and lies to us, not the Fed, the Bureau of Labor Statistics, and says housing costs rose 4.4% from a year ago. That's a lie. Everything's a lie that comes out of the government these days. Don't believe any economic figure that comes out. Always consider it to be worse, and significantly worse, whether it's the GDP, whether we talked about a couple of weeks ago the jobs numbers in January. Everybody expected small increase in jobs, and it was like 5 times what people expected. Goldman Sachs expected 255,000 jobs lost. ADP, which has their own payroll, they know exactly what's going on because they see the changes in payroll. Said that 300,000 jobs were lost in January from their figures. But the country came out and said, no. I even forgot how many jobs they said were created, 500 and something thousand. All a lie. All a lie. And when it comes to inflation, the inflation figures are a lie too. You can't have energy up 60%. You can't have coffee up 100%, food and meat and everything else. Cars, homes, everything. And try to tell us that inflation is 7.5%. Big problem. The Fed can't fight it. Get used to it. And you're going to have to learn how to navigate an inflationary period. It's been a long, long time. 40 years since we've seen inflation like this. And in my opinion, it's here to stay. Let's take a break. 732-237-9626 is our phone number. My name is Lou Scatigna. You're listening to The Financial Physician right here on 92.7 WOBN.